Good morning, everyone. Thanks for joining us. I might just give another couple of minutes to see if we've got any latecomers, and then we'll kick off with the half-year results for Damstra. Thanks for coming. All right, we might kick off, everyone. Once again, thank you very much for coming today for the financial year 23 half one results. I'll be presenting today myself, Christian Damstra, and of course our Chief Financial Officer, Paul Burrows, is online as well. We'll be presenting the more detailed numbers. Paul, can you advance the pack a couple of slides, please, and we'll get straight into it. Right here, thanks. And if you've got any questions today, please put them in the Q&A section and we will answer them as with the end of the presentation. So, of course, Damstra is a global provider of enterprise protection solutions. We're out there with a mission that's focused on worker safety, risk management, and organisational compliance. We want to ensure that all those workers go home in the same condition as when they arrive. That's always been our ethos. It's something we're very proud of. It's something we work hard to achieve, and we continue to forge forward with that mission today. Next slide, please, Paul. Okay, so the key financial metrics for the first half, very pleasing results. We've worked very hard in the organisation to really turn the organisation and right-size it and put it in the right place to leverage the organisation as we grow. We had record revenue of $14.9 million, up 18% on PCP. EBITDA of a positive $2 million versus a negative $0.2 million on PCP. Gross margins up to 78.3%, so up 4.9%. Cash receipts $17.3 million, a positive increase of 17.3%. Operating cash flow, positive $2.1 million. I mean, that's off the back of a PCP negative of $2.1 million, so major gains there. 39.5% R&D, down from PCP of 49.2. $11.6 million of gross profit being up 19.4%. 103% net client retention, 2.5% client churn, and 27.6 million ARR, which is consistent against PCP. Next slide, please, Paul. So improved revenue quality, some of the highlights for the half yearly. I mean, record half year revenue of 15 million, revenue up 18%, long-term growth, the 5-year CAGR of 26%, and of course, half one financial year 18 revenue of 4.7 mil. North American revenue for half one, greater than $1 million. So we're really starting to kick goals over there. We're getting that traction we need, and we'll continue to support the North American market on that. International revenue now sitting at approximately 21%, and the successful rollout of stage one Barrick went extremely well in the USA, Republic of Congo, and Dominican Republic. Stage two has begun now, and we're already talking stage 3 and 4, so really positive news coming out of that area. Improved business metrics, I think we'd all agree, gross margin 78.3%, heading in the right direction. That's a margin improvement of 4.9%. And of course, positive EBITDA of $2 million, which is really quite substantial from where we were in the PCP. R&D is reduced to 39.5% from 49.2%, which really does recognise that we're over that hump of integrations, and we're really stabilising our platform and continuing to grow, and I'll talk about that a little bit more shortly. Client churn continues at low levels, 2.3%, with net client retention a positive 103%. Improving cash metrics, cost savings target of 8.2 million achieved against that original target of 8 million. We're now seeing cost savings running at 700,000 on a monthly basis, achieved in December. 3 consecutive quarters of positive operating cash flow versus FY22 average quarter of negative 0.9 million. Cash outflow material reduction in Q2 FY23 of 1.2 million versus FY22 average of 3.4 million negative. So real improvement there as well. So some really good numbers. We feel we're heading in the right direction there. Next slide, please, Paul. It really has been an inflection point for the business, and I think that's evident in the numbers. You can see H1 FY23, the positive inflection for the business, reducing the OPEX and below gross profit with revenue still increasing. So you can really see there the OPEX line turning around, heading down, and continuing to trend that way. And of course, we're constantly monitoring that and doing more work internally to look for further savings. CAGR of 26% over the 5 years, as mentioned previously. Next slide, please, Paul. Just a little bit about some of the long-term implications of what we've done with the cost savings in the business and how we've achieved these results. Of course, we've had the growth in North America with revenue now greater than $1 million, but it's also got the scale to accelerate, and we've got a lot of opportunities we're working on over there. North American clients have demonstrated that we have a globally competitive product that really does work in that region. Our 2 largest verticals of civil construction and mining have been extremely resilient in the present economic environment, and we see a lot of growth opportunities still coming through that. Civil construction is a long-term growth engine in Australia. Of course, we've got a lot more leverage in the business today. We can continue to grow our gross margin while reducing our costs. Leverage has been shown at the EBITDA level and also the gross margin level. You can expand those margins with increased revenue without adding a lot of incremental costs, which is certainly what our goals and our aim is right now. Operating cash is now structurally positive, and we have that pathway to free cash flow generation extremely clear. Our cost management program has delivered a step change in the cost base, and we have been able to continue to grow the business while reducing that cost base. Past acquisition and one-off costs are now behind us, and we have identified further cost savings. They're not people related. We're still quantifying them, and we're continuing to work through those on a daily basis. The EPP development is strategically focused now on the existing client base to increase net client retention and reduce churn. We have multiple opportunities in our present client base, and also to sell across our modules to increase the ARPU per client, which I'll actually talk about for the first time a little later as well. Of course, form, safety and workflows are now integrated into workforce management, solving clients' complex issues around compliance, and the market continues to grow in this area. R&D was a material positive step change as a percentage of revenue. It is maturing as a product, the EPP. We've brought those legacy systems in. Present and future development is focused on deeper integration and more functionality. And of course, we're continuing to make sure we've retired all those legacy products to enable even further savings as we move forward. You can now see the business profile being operated in 25 countries, 15 different languages, and our top 50 clients average monthly half-year revenue of $37,000. Key metrics for the business going forward will, of course, include that ARPU. Multiple clients are deploying solutions globally, demonstrating organizational capability. So some real positive implications of the changes we've made there. And I'd also like to point out, after all the implications, all the changes we've made, we're still getting extremely solid net promoter score from our internal staff. So we're continuing to support our team and continuing to grow and look after that team. Paul, next slide, please. Next slide. I'm going to hand over to Paul here and let Paul talk to the more detailed numbers, and I'll be back to talk a little bit more about the business in just a moment. Thank you, Paul.
Yeah, thanks, Christian. So if we take a bit closer look at the underlying financial numbers, we can see an increase, a strong increase in revenue over the last 2 comparative periods, from 12.1 million in H1 FY21 to 14.9 million in H1 FY23. As Christian mentioned, we've had an EBITDA improvement of 2.2 million, and that's come at a margin of 13.4%, which is now returning back to historical levels. A gross margin improvement of 1.9 million at a margin of 78.3% is 490 basis points improvement. You can see across all expense categories that we've had a reduction. with the largest reduction coming through on the R&D line. And we'll talk about that a bit more going forward. Another way of looking at this is our cost as a percentage of revenue. And again, you can really see the reduction in cost as a percentage of revenue, which is demonstrating the leverage that's in the platform that we're building. So we've increased revenue and reducing costs proportionately. And we expect this to continue with the annualised cost saving run rate now hitting, monthly run rate now hitting 700,000 from December and going forward. And it's this is the key metric that is a pathway towards us achieving our positive free cash flow. Looking at the cash flow, our H1 highlights, we had operating cash inflows of 2.1 million. This compares to 2.1 million outflow, or a 4.2 million improvement in the prior period. We had free cash outflow of 3 million versus 6.7 million, again a $3.7 million improvement. On a quarterly basis, our Q2 results for operating and investing were 33% better than our Q1 results and 65% better than the average of FY22. And you can see the run rate on the graph there that it really is highlighted. Our gross profit and margin is demonstrating our structural improvement. We've achieved growth in both areas. So a gross margin of 78% is exceeding our historical levels. And it's the cost savings that we've achieved that have delivered this in a sustainable way that will be achieved ongoing. So R&D as a percentage of revenue is on a downward trend. There's been a step change from FY22 of 50% of revenue down to 39.5% in the first half of FY23. And that's the lowest R&D spend for the first four halves. And it's driven again by our cost-saving initiative, which has achieved a deeper integration of past acquisitions. We expect this trend to continue, and it'll come through increasing revenue and retirement of legacy systems, and will continue to benefit from the cost savings program. We achieved 8.2 million of annualised cost savings in December. It's against the target of 8 million. And as we've said, that's now at a run rate of 7 million on a 0.7 million on a monthly basis. You can see from the graph the incremental uplift in the last quarter, and it's that incremental amount that will differentiate us into the second half and ongoing. We do think there's extra cost savings in H2 FY23 that aren't in this program, and they're being planned and implemented. And importantly, we've achieved this by still maintaining a positive net promoter score. And finally, we've provided the reconciliation of our pro forma results back to our statutory results for your information. And I'll hand back to you now, Christian.
Thank you, Paul. If you can go to the next slide, please. So we are a global provider, as mentioned at the start. Our business profile in the last 4 months has changed and continues to evolve. We're now operating in 25 countries. We've got greater efficiency with 9 offices now, down from 12, 180 employees, down from 220, and we're operating in 15 languages, up from 1 language just 1 year ago in 2 years ago in FY21. And for the first time, we are now reporting on ARPU here. So you can see there that top 20 customers in the first half of FY22 were 80.4K, up from 60.4K in December 21, and 37.1K for the top 50, up from 28.3 in December 21. Next slide, please, Paul. Our strategy for FY23 and our half-year update really hasn't changed from moving to that stage 2 rollout with Barrick, in addition to expanding with other North American clients and getting that North American business really moving forward, continuing to work with those Asian opportunities. And we've got a big pipeline of projects to be implemented in the second half of FY23 in the construction vertical, which is materially stronger than the first half. Effectively, we had a lot of projects roll out towards the end of the first half, and they're now going live and really ramping up in the second half. And we've also got new projects kicking off in the second half. So real positivity there and helping us move forward to close that gap to hit our forecast for the year. So looking forward to growing those opportunities as we move forward. New verticals, of course, CBRE is rolling out with Macquarie Bank. It's been going extremely well, and they're looking to expand to a full global relationship in the second half, making great progress there. In the mid-market, a lot of cross-sell opportunities. We're seeing a lot around forms linked into our safety and our learning modules. So we're continuing to grow that and put a lot of effort into those areas. And of course, our local and global partnerships are continuing to evolve, including with Amazon Web Services, who are certainly marketing us to their resource sector quite actively at the moment. Our new company portal is about to be launched in the second half, reducing costs and enabling new client opportunities. We're really looking forward to getting that out in the marketplace as soon as possible. Key focus on retiring our 2 legacy platforms that are really sitting out there, which enables more cost reductions and further reducing our R&D costs, and also allows that cross-sell to happen more easily. The EPP is continuing to evolve with North American clients, and all changes are available to all clients. No customization in there, which is looking great. Of course, our Q2 cash outflow of 1.2 million versus the average of 3.4 million last year was a major step forward, and we're going to continue to improve that and get to that free cash flow break even. And of course, our cost out optimization at 8.2 million over the 8 million target, with further savings identified. We're now operating EBITDA positive, cash flow expanding with increased revenue and achievement of those cost savings. Paul, next slide, please. Revenue growth is coming from a diverse range of industries, so there's a lot of protection there. Of course, construction and mining being the lion's share. And of course, it's important to point out that that's major infrastructure in construction, not residential housing. And of course, mining going extremely strong there as well. Next slide, please, Paul. As you can see, a bit of an update on the construction trading environment here from Infrastructure Partnerships Australia, showing how much is actually happening out there at the moment that's been awarded all the way through to perspective. So a big tail there, big pipeline coming through. And of course, we're in with all the major players in that area. They're our customers. We're continuing to work with them and grow with them. And we see a lot of opportunity coming through the pipeline for us off the back of that construction growth moving forward. Next slide, please, Paul. Next slide. A little bit on the product update. Of course, Barrick is only using a small portion of our system, which shows how our modules actually fit together. But they're using management of skills and the skills matrix and deep integration with digital forms and those types of things, but they're not using our access control or our actual workforce pre-qualification and contractor management. And all of those things are actually in discussions, in front of moving forward after we do our first 4 stages of the rollout, which are going extremely well and extremely positive. Next slide, please, Paul. Our go-to-market strategy to drive that growth. Of course, we're still bundling the EPP up. We talked about that before with safe places and prepared people. We've got those product extensions with the safe work method statements, the permits to work, plant and assets, and supplier pre-qualification. So really some core changes there. Things are moving forward, and a lot of demand for this from our existing clients as well, which is where we're getting that cross-sell. Next slide, please, Paul. Of course, we are positioning ourselves as a leading integrated solution. And that's been backed up by research firm Vedantics, putting us in the top right hand of the quadrant for greater than 5 use cases and greater than 200 employees. Next slide, please, Paul. We are continuing to monetize the integrated and modular EPP. I'm sure some of you have seen these screens before, but the look, the feel, the speed, it's continuing to improve and continuing to be adopted. And we're really pleased with the uptake of the enterprise protection platform across our markets. Next slide, please, Paul. We are also solving the management of learning and development in mining sector. So not just focusing on what skills have you got, what competencies have you got, are you safe to work, but giving you learning pathways. The learning and development platform that looks beyond compliance and taking you through to that pathway for your employees, meaning ideal sequences of learning, activities that drive workers to reach proficiency in their job roles in the shortest possible time. A clear vision for employees on how to develop their skills for their career and their personal growth. A clear trajectory, marked milestones and a final destination so they can actually increase their salaries and increase their opportunities in their networks. The benefits for organisations are helping them achieve organisational goals, increase employee engagement, improving retention, and more structure and increasing productivity across their organisation. It's been really well received. It's being used actually by Barrick and Capstone in the US, and some of our Australian clients are actually looking over it right now. So we're really pleased with how it's been picked up. Next slide, please, Paul. Of course, the enterprise protection platform in real life for Barrick, that we've actually digitised what they call their MSHOR form, which is the Mine Safety Health Act of America. They've got to do this form for every employee every single year. It used to take them over a month to do that for all their employees. We've now digitised it. We've brought that down to weeks, and we're actually going to actively market that to every mining organisation in North America because it's never been digitised before. It's a very powerful solution. It's not just about digitising a form. It's about taking training records from the training database, from the e-learning system, from the time they've been on site, and auto-populating the form, closing the gaps, getting the digital signatures, and submitting it to the authorities. So it's a very powerful solution that we've spent a lot of time developing with Barrick in partnership, and we're really pleased with how that's progressing. Next slide, please, Paul. Of course, confirming the outlook on the next page. Revenue guidance still in place there. Our outlook is still with EBITDA margin in H1 of 13.4 was achieved, of course. Our gross margins have improved 490 basis points to 78.3%. In December, we hit a run rate of 8.2 million of annual cost savings, equaling approximately $700,000 per month. Free cash cost outflow was 1.2 million, a 65% improvement on the average of 3.4. Our second half revenue in Damstra has historically been seasonally higher than the first half. That is an historic number and certainly trending the same way this year. I know there's a couple of questions there on that that I will answer in just a moment, but effectively you've got those further rollouts, the people registering on the projects that got implemented in the first half, and of course the new projects that are rolling out in the second half, and that's why the second half is traditionally stronger than the first half. We still have continual resilience in our two largest verticals, mining and construction. The pipeline is larger in the second half once again, and client churn, we're expecting that to not materially increase from the 2.5% achieved in the first half, which we believe has stabilised as it reduced to 2.3% in Q2. I think a good solid set of numbers there. Our EBITDA margin is still there at 14 to 18%, and free cash flow as advised. Next slide, please, Paul. All right, that's the end of the presentation. I will pause there and go through some of these questions that have been asked. First one was from John. I think we answered that about why is the second half stronger. It really is about the full rollout of those projects that went in the first half, and also those new projects that are coming alive in the second half that we won in the first half. So we are quite confident that that is increasing, and we'll continue to track that and report to the market as appropriate. The international opportunity, talk us through the international opportunity and the total contract value available in Barrick over time. Look, Barrick is a global rollout. Of course, it's broken into stages purely to help with that rollout to make sure it goes smoothly. We did the first 3 sites in 3 very dispersed regions on purpose so that we were ready in each region. Stage 2 is happening right now in Nevada Gold Mine. So there's another 6 sites going live there over the month of February and March. Then we start phase 3 and 4, which includes EMEA and more in Africa and Canada and their other sites. Total contract value fully rolled out is north of sort of $1 million US and continues to grow with the other opportunities. And we look forward to finding more opportunities with Barrick as we move forward. We did get after we opened our books to Excel KKR in July last year. Look, and what are the options we're exploring to maximise shareholder value? There's sort of 3 questions there, and I did note you have dipped into your credit facility, now to shore up the cash position. But what's the medium-term plan? That was asked by Ben. Look, on KKR, I don't really have any comment there. It was speculation that they were sniffing around, and we talked to a lot of companies who come to our door. Some of those companies are looking for bargains, if you like, for want of a better word. And of course, we have to look for that shareholder value. I, like you, am a large shareholder in the organisation, and we need to make sure that we're working as hard as we can for every shareholder. Certainly we do get tie kickers every now and then coming around. As far as the options to maximise shareholder value, I think right-sizing the organisation, changing our cost structure, really returning the business back to a cash flow positive, cash flow generative, EBITDA positive, profitable organisation moving forward will help to restore that shareholder value. And of course, if we get people coming and knocking on our door, we will entertain those conversations as long as the value is there for all shareholders, as you would appreciate. We did dip into our $5 million credit facility just to shore up the short-term funds. We are certainly in a good cash position right now, and we are going to be generating cash by the end of this financial year, and that's in our targets, and we're getting more cost savings to achieve that, increasing that revenue, which is dropping straight through to the bottom line, and that will keep us moving forward in the medium to midterm as well. Paul, was there anything you'd like to add to that?
No, I think that covers it, Christian. Yeah.
Thanks, Paul. An anonymous attendee, could you talk to the assumptions around our guidance in the second half? It does assume a step up. Look, it does assume a step up, and it's not a major step up. I mean, if you did 15 in the first half, if you do the same in the second half, another 15, and you add a couple of mil on top, it's not a major step to get you to the bottom end of your guidance. We have spoken about how the second half is materially stronger in history and is continuing to trend that way, and we're working hard to make sure we achieve those goals. So that's the answer to that one. Alan Rising made comment, great discipline with regard to expenses. Well done. Thank you very much, Alan. It hasn't been an easy journey, but it's one we had to take, and we're glad we've gone down that path. And has the COVID generated interest in worker safety completely dissipated, or is it still higher than pre-COVID? You know, I think there's swings and roundabouts there. I think that it's very similar to pre-COVID. I don't think it's really generated any greater demand. I think there was some of those shoot from the hip movements throughout COVID that have now gone, and we're continuing to follow pre-COVID growth pathways from that. I don't believe it's really given us any tailwinds. Alan also asked, has work from home had any impacts on customers' need for Damstra services? The answer to that's no, because if you look at the industries we work in, typically they are field-based industries, so construction, resources, telecommunications, of course, our FMG space. So, I mean, those industries do require people on the shop floor to achieve those outcomes. So we haven't really had any headwinds from that. Hamish, is your $15 million loan due in June 24, and how do you anticipate paying for it? Paul, I might pass that one over to yourself if you don't mind.
Yeah, thanks, Christian. Look, we've got very good relationships with our debt provider. I think we expect to have some leverage in the business going forward, and as we start generating free cash flow, we'll obviously draw down, repay some of the debt, and as our all of our metrics are improving, it's opening up further debt options for us with different providers. Not saying we're going to increase the amount, but just who the provider is. So, I don't think we're looking to pay back $15 million as on June 24, but maintain some leverage in the business and the good relationship we have with our current provider.
Yeah, agree. Thank you very much, Paul. Ross Barrows, you've asked, we've mentioned price rises have been put through 50% of our customers, with another 25% possibly addressed in the second half. Can you quantify the size of these increases? Can't quantify it exactly, Ross. We are working on putting those rises through to at the lower end of town customers, as well as increasing some for additional modules, of course, at the higher end of town. I'm not going to put a dollar number on it. It is not materially significant as in the millions, but it is significant across the board, and we are working with our customers to get those signed off. Hamish, you also asked, is there any indications that current clients will renew their contracts? Of course, we are always in discussions with our clients. We've got a great relationship with our clients, and there's indications that all of our clients will continue to renew their contracts. There's no discussions around any contracts coming to an end. We have had a couple of contracts where we've actually got in front of us at the moment with 5-year extensions and things like that. So very positive there, and we'll continue to work with those customers moving forward. Anonymous attendee asked, Can you talk to the scope of what the second stage of Barrick would be, or dollar potential for expansion of that contract compared to where it is at the moment? Should we expect the Barrick revenue to double? We actually made an announcement on the market for the second stage of Barrick. It was a circa 400K contribution for those 6 sites of ARR, not taking into account, of course, the implementation fees. That does substantially increase. I'm not sure it doubles it at that stage, but certainly 3 and 4 will come through and increase that once again. Ross Barrows asked, one for yourself, Paul. R&D capitalisation increased from 39% of R&D to now north of 50 at 54. Looks like this resulted in the R&D expense falling, which is a meaningful tailwind to the EBITDA result. How should we think about capitalisation rates in the second half of 23 and going forward?
Yeah, no, thanks, Christian. Look, overall, we did have a slight increase in R&D, about 300,000 for the quarter, but overall the R&D expense did decrease. And that's just the nature. We apply our R&D policy, our capitalisation policy consistently, and it's just the nature of the projects that we are doing. I guess we would see that probably being pretty consistent into the second half, potentially a slight decrease as we get through these integration projects and the maturity of the platform. So, but yeah, there's an overall reduction in expenses and a slight increase in capitalised R&D.
Thanks, Paul. No other questions there at the moment. If you've got any, please put them in there. I think overall, though, a very strong set of results. We're, of course, working very hard internally to meet the forecast numbers. We've got a lot of opportunities in front of us. Everything's trending in the right direction. It's great to see us right-sizing the organisation from a cost perspective, a people perspective, continuing to, of course, follow that net promoter score and positivity amongst our own staff base. And some of that's come around from, of course, consolidating offices and things like that as well. So really pleased with how the entire team's been functioning and achieving these results. Still no further questions, so I will, of course, close the meeting out now and say once again, thank you very much for your support. Thank you for following us. Thank you for attending today and asking the questions. And we look forward to keeping you updated in further announcements and meetings as we move forward. Thank you very much, Paul, as well. Thanks, everyone.